Welcome to my channel. I'm Scott, and in this video we're going to talk about the stock market. Here are the slides we're going to cover. We're going to talk about the basics of the market. How do you buy stocks? What is a shareholder ownership? We'll talk about preferred stocks, stocks versus bonds, the capital structure, and a summary at the end. So let's first discuss the basics. I define a stock in 3 different ways. It's a security that's equivalent to a small piece of a corporation. Another way to think about it is it's equity that represents the ownership of a fraction of the issuing corporation. Or you can think of it as a portion of a corporation's profits and assets. Companies that issue stock do so to fund operations, also to fund growth, maybe to acquire another company or to build another factory. The 2 main types of stock are common and preferred. Most people watching this video buy stocks on one of the many stock exchanges all around the world. There are many stock exchanges. The biggest one in the world is the New York Stock Exchange. The Nasdaq is also really big. If you want to invest in smaller companies that are less liquid, you can invest on the OTC pink sheets. And these 3 exchanges are in the US, but there's also many more in the US. If you live in Canada, you can invest on the Toronto Stock Exchange. If you want to invest in smaller companies in Canada, you could go on the TSX Venture. There's also the Canadian Stock Exchange. The Frankfurt Stock Exchange is one of the top 10 biggest exchanges in the world. I think there's 9 exchanges in Germany. There's also the Xetra and Börse Stuttgart. Another top 10 exchange is in Japan, the Tokyo Stock Exchange. There's also the Nagoya or Fukuoka. If you live in China, there's a Shanghai Stock Exchange, the Shenzhen, and the Stock Exchange of Hong Kong. If you invest in the primary market, that means you're buying the stock directly from the company when they IPO. But I think all the shares of stock I bought and sold were in the secondary market. And that's how the stock price goes up and down in the secondary market based off of supply and demand. And when the company IPOs, they do receive that money when they initially sell the stock. But after the IPO, if the stock price goes up 1,000%, the company doesn't make any extra money. It doesn't really matter to the company how the stock does. For example, if Tesla's stock doubles this month, it doesn't mean they sold twice as many cars. And if Tesla's stock goes down 50%, it doesn't mean that car sales went down a lot. The stock price and the fundamental operations of the company are separate. The only 2 instances it benefits the company when the stock price goes up is if they want to raise more capital. And if they want to issue more stock, they can do so at the higher price. So it's better for a company to issue stock when their stock price is high as opposed to when their stock price is low. If their stock price is low, then they should buy back stock. Another benefit for the company when the stock price goes up is their convertible debt converts from debt to equity. When that happens, it improves the company's balance sheet because it lowers their debt. But of course, it's possible that convertible debt never converts to equity if the stock price doesn't increase much. If you want to buy stocks, you'll need the assistance of a stockbroker. Most people buy online through E-Trade, Webull, Robinhood, Schwab, etc. Because most of us can't just call up the stock exchange and buy directly from them. We need to go through a broker, an intermediary. There are some big companies that do offer direct stock purchase plans. You'll need to contact the company directly and buy through them. This is similar to employee stock purchase plans. At previous companies I was at, the company would offer employee stock purchase plans where you could buy the stock at a 10% discount. But you don't get a discount from DSPPs. And the 2 order types are market orders and limit orders. So if you buy or sell using a market order, that means a trade will go through immediately at the current stock price. If you're trading on a major exchange like the Nasdaq or London Stock Exchange, then there's lots of liquidity, so the trade will go through right away in a market order. But if you trade OTC, it may take a little while to find a buyer or seller. If you don't want to trade at the current price, you could pass through a limit order, and this allows you to set a specific price. And you could also set a time frame. You could set it up for 24 hours or you could set it up for 60 days. Or really whatever option you want. So Apple is trading at 157 today. You could put a limit buy order in at 150. So your broker won't buy the stock until it hits 150 or lower. The downside of this is if Apple stock goes up a lot, you do miss on that upside because the stock price may never come down to 150. And you could put a sell limit order at 165 for Apple. So if the price gets up to 165, then you'll sell your stock. But if Apple stock crashes a lot, it goes down to 120, then you may lose out because you could have sold it at 157, but you put that limit order in. It's pretty simple the way the stock price changes. It's based off the supply and demand of the market. The more buyers than sellers, that means the stock price increases. And the more sellers than buyers, the stock price decreases. But how do you predict when there's going to be more buyers than sellers? Well, if the company has a strong quarter, more people may buy the stock. Or another reason people may buy the stock is if there's lots of positive news about the company. And if the company has a weak quarter, that could be a reason there's more sellers than buyers. But the list could go on, the number of things that can influence the stock price. So what is shareholder ownership? So when you own stock, you own shares issued by a corporation. But you don't actually control any assets. Senior management and board members control the assets and decisions of that company. It's not like owning your own small business. If you really needed money, you can sell assets if you wanted to. But when you own stock, you could only sell your stock. When you own stock, you do get a vote in shareholder meetings. But the only way to get your voice heard is if you own lots of shares, say above 10%. You also have a right to receive a dividend. That's only if the company offers one. And you also have the right to sell your shares to somebody. That's if you can find a buyer. But if you're trading a stock on the NASDAQ, it's pretty easy to find a buyer. A shareholder is entitled to a portion of the company's profits. So the more shares you own, the larger portion of the profits you get. Just because you're entitled to a portion of the profits doesn't mean you'll get the money right away, only if they pay a dividend. But many companies don't pay out dividends. Lots of companies reinvest the money back into the company. This is called retained earnings. It's on the equity section of the balance sheet. Let's talk a little about preferred stock. So preferred stockholders don't receive voting rights, but they do have a higher claim on assets than common shareholders. Preferred stockholders receive a guaranteed dividend payment before common shareholders receive their dividend payment. And it's optional for a company to pay a dividend payment to a common shareholder, so you may never get one. But if you have preferred stock, it's guaranteed. And preferred shareholders sit higher on the capital structure, so they get paid out before common shareholders. And a company can issue more common or preferred shares, which is dilutive. It makes your shares less valuable. And if a company has extra cash, they can buy back shares, which are anti-dilutive. So the two main ways to reward shareholders is to pay a dividend or to buy back stock. And the two main ways to detract from shareholders is to not pay a dividend or to issue more stock. So let's talk about stocks versus bonds. Bondholders are creditors to the corporation. They're entitled to interest as well as repayment of the original bond principal. So creditors have legal priority over equity holders. So in the event of bankruptcy, they're paid first. And when a company goes bankrupt, stockholders generally receive nothing, which implies they're much more risky than bonds. But the reason people invest in stocks is there's unlimited upside. A stock can 2x, 5x, 10x, 100x, where bonds just receive their fixed interest and principal payments. The nice thing about preferred stock is they share some of the characteristics of common stock and bonds. So they're riskier than bonds, but safer than common stock. I think if we look at the capital structure, it'll make more sense visually. So this is a typical capital structure, and the riskiest investment is on the bottom, the common stock, but it has the most upside, and the least risk is on top, the senior secured bonds. An example of secured debt is your mortgage. The bank provides you a loan, and the collateral backing that loan is your home. So if you default on the mortgage payment, the bank could take your home, sell it, and recoup some of their money. That's why the interest rates on mortgages are a lot lower than credit card interest rates. An example of a senior unsecured bond is your credit card. If you default on your credit card, There's no collateral backing it up. So that's why you have to pay a higher interest rate. And then next in the capital structure is convertible debt. So if you hold this debt, you can convert it from debt to equity if the stock price hits a certain point. Then next in the capital structure is preferred stock, which we talked about. That has a fixed dividend payment and some capital appreciation. Then on the bottom is common stock. An example of common stock is Tesla, which you can buy in the open market. So if a company goes bankrupt, they first sell all their assets, they take that cash, pay off their senior secured bonds. If there's money left over, they pay the senior unsecured bonds. And if there's money left over, it keeps going down the capital structure until there's no money left. That's why common stockholders usually lose their entire investment. There's usually not enough money to get to that point. So to summarize, you can invest in thousands of stocks and bonds. You can buy Microsoft preferred stock, Apple common stock, AT&T debt. The list goes on and on. Common stock is the most risky, but has the most upside as well as the most downside. Debt is the least risky with the least amount of upside and the least amount of downside. So debt is ideal for someone with a short time horizon, like under 5 years. It's also good for someone with a low risk tolerance. Equity is ideal for someone with a long investment time horizon, like over 10 years, or someone with a higher risk tolerance. So I hope you learned something new in this video. Please subscribe, leave a like, comment. Talk to you soon.